Good morning, people. I'm Craig, and welcome back to Investing with Craig. As you know, in the last episode, we talked about getting gold into your portfolio as a wealth builder and wealth protector in case of high inflation, which some of us are expecting to happen with all the crazy money printing. And I told you at the end of the last episode that the next logical step would to talk about the leveraged plays on gold. Instead of physical gold and silver, we're going to talk about miners. So I want to show you, just as full disclosure, the companies that I presently have in my portfolio. Now, one thing I definitely want to say, I'll try and remember to say this on every episode, is of course, I'm not your financial advisor. I don't know you. I don't know your risk profile. I don't know anything about you, so don't consider me your financial advisor. Don't consider anybody you either read in a blog or on YouTube to be a good source. Always do your own due diligence. So I'm just showing you these companies because I know a lot about these companies. I do very deep fundamental analysis on any company before I invest. And then my next step is to do technical analysis. Once I decide I want to invest in a company, I then go into the charts and I look at the technical analysis to see whether it's a good time to get into that company, whether it just coincidentally at the time you found this company and you researched it, maybe the stock's at all-time highs, it's way overpriced, and you want to wait for a pullback. So that's the next step. No, we'll do that today, but I don't have time to go through all of these companies. As you can see, these are in order, by the way, of the market value in my portfolio. So my number one market value one is first Majestic Silver, then Royal Gold, which is actually a royalty company. And that's the one we're going to talk about today. That's why it's in a different color. Then Gold Mining Inc., US Gold Corp., Gold Standard Ventures, Kirkland Lake Gold, Artemis Gold, Lumina Gold, Oseco Developments, Equinox Gold, and First Majestic Gold. I know it's a mouthful. I've got a lot of gold companies in my portfolio. But today I just want to talk about Royal Gold. And I want you to know the only reason I'm picking this one out of all the other ones is because this is the one that if I had to suggest it to my mother or somebody who absolutely could not possibly take a risk of losing their money, then this would be the one I would suggest. It's a gold royalty company as opposed to a standalone gold mining company. And as you see when I show you the fundamental analysis, this company is rock solid. It only has 29 employees and they make so much money. They've pretty much for as long as I've watched their books and their numbers, they've never lost money. They pay a dividend. They always increase the dividend every year. It's just a rock solid, about as blue chip as you're going to get in the mining industry, in the gold mining industry. And I think it's one of those ones that if you could only invest in one gold mining company, again, just my opinion, not your financial advisor, so do your own due diligence. But this is the one that if you could only own one, I would say this is the safest, also the most profitable, and also the one that pays you a dividend in case that's important to you. So there we go. So what we're going to do is go into the actual investor presentation they just did March of 2021. So this just went by. So this is the freshest numbers, the most up-to-date numbers. And I've highlighted some things in here to make sure I don't forget to highlight it for you. And as you can see, this is the fundamental deep dive stuff that you want to do just to see if this is a company you want to own. And then the next step will be the technical analysis. So the stuff I've highlighted is this is a royalty company. So I don't know if you know what that means. We'll definitely go through what that means so you won't be confused. It's an opportunity to capture value in the precious metal sector without incurring many of the costs, risks, and associated with mining. So what that means is they don't actually own the mining companies. The mines that are there, they are in essence a specialty, partner that will partner with existing gold companies who need a little bit of an influx of currency, money, to either expand their mine or just to start it. Maybe they've got the pre-feasibility study done and they're all ready to hit the ground and build that mine that's going to start producing gold, but they don't have enough money to produce a mine. A mine is very expensive to get up and running. And a lot of these companies, they spend all their money in drilling, and pre-feasibility studies, and engineering, and all this stuff. They prove the gold's there, and then they look at their coffers and go, the only way we can afford to build this mine now is to super dilute our existing shareholders by just throwing tons and tons, millions of shares on the market to try and raise money. But then the shares for the existing shareholders go now down to next to nothing, and the shareholders are upset. So a better option is to go to somebody like Royal Gold Incorporated. You've also heard of companies like Franco-Nevada. I used to own them. They used to be on my list. I actually sold them recently because I wanted to free up some money to go into a cryptocurrency miner, which we'll talk about in another episode. But that's why sometimes when you see better opportunities, you've got to sell one thing in order to get another thing. And I already had Royal Gold, and I believe between Royal Gold and Franco-Nevada that Royal Gold has better growth opportunities. So there's two streams they really have. They have royalty interests and they have stream interests. So as you can see from reading it, a royalty interest is they provide the right to a percentage of the revenue of the metals produced from the mining project after deducting specified costs. So that's a royalty interest. And then other times they set up a contract with the mine for stream interest. It's a contractual arrangement to purchase metals from the mine at a predetermined price. So to put it into layman's terms, the royalty interest means they're going to get a percentage of all revenues. So they'll loan them, let's just say a number, $10 million, and they'll say, okay, Royal Gold doesn't just give money to people and say, we trust you. They get in there with their own engineers, they check the numbers, they make sure that the mine is ecologically friendly, that it gets a good score that way, that it's got a good relationship with the local population. They don't want any bad publicity if they're going to loan a company and they're going to become the partner. They don't want any bad publicity, and you'll see that later in their presentation. So one type is, okay, you maybe at one mine they have copper, silver, nickel, gold, a bunch of different things. So it's easier for them to say, okay, whatever you mine out of this hole in the ground, we'll take 10% for the next X number of years or until we get to a certain maximum amount of money. And then they'll figure out what their rate of return would be for that. A stream is, you say you have a ton of gold in the ground, but there's a lot of drilling left to be done. So they go, hey, it's smarter for us to say, look, we'll take whatever 10% or 20% of all the gold that comes out of this ground into perpetuity, into the future. So those are the two ways they do it. So the other highlighted things, and this is, you're going to see this right away, why I suggest this company, their profitability is off the charts, like higher than even a tech company. You think a Tesla is profitable, or you think a Apple's profitable. It's nothing compared to these people. So they this is for 2020, the full year. They brought in $499 million, so $500 million in revenue, which worked out to gold equivalent of 320 ounces. They have available liquidity to them. That's either cash or line of credit that they've already got set up at. Of course, these interest rates these days are like next to nothing for a company with this kind of balance sheet. So they can obviously use that money if they see a really great opportunity. They can not only have cash on hand, but they can dip into their line of credit, so to speak, to buy that or partner with that next company if they see a great opportunity. And they don't jump on something every year. They average one a year, but you'll see later in the presentation, some years they have 2, 3, and 4 in 1 year, and then they won't have any for the next 2 years. So if they'll only jump on something if they see it's really got a great rate of return. Their net debt is only 0.41%, so they have less than half the debt of the cash that they have. So that's a really low debt rate. Market cap $7 billion. That doesn't really matter. This is the part that's interesting. Company with $500 million in revenue, and they only have 29 employees, and that's spread across 4 locations. So that's why you're going to see in the next presentation that they are super profitable. Just showing diversity too, they have 189 properties in 12 countries. So unlike a normal gold mine where you really are sunk all your money into one hole in the ground and you better hope it pays off, this one's got 189 properties on the go and 12 countries. So if one ends up kind of not doing as well as they thought based on the feasibility studies, it's not going to hurt the company that badly because they got 189 going. So there you go. And they are 79% gold focused. As you can see, they also have copper, silver, and other metals coming in. Down here, efficiency model with high operating margins and revenue generation per employee. Again, talking about they almost have no overhead because they have very few employees, and they make a very good rate of return. Revenue from gold, 29%. Global diversification with revenues from 41 producing properties. So at the 189, that's how many gold mining sites they have. But of that, only 41 are presently producing. All those other ones are in that just about to start producing stage, and you'll see that. So it gives you that $499 million is actually just from those 41 properties. Wait till all those other ones come on stream. The revenue in the future is going to go up astronomically. Well capitalized, $1.2 billion of liquidity. What part of that is a $1 billion credit facility? This is their rate of dividend increase. They've averaged from 2001 to 2021 a 17% growth rate in the dividend they pay out. That's amazing. And I looked at the graph, and they've never gone down, even in bad gold times. And we'll see that in a chart later. This is interesting too. So the beta versus gold. So because they only put up a little bit of money and then they get this great return, when gold goes up, this company goes up more. So it's got a 1.77 beta, which means if gold goes up, 10%, this will go up 17.7%. I guess theoretically, if gold goes down 10%, I guess this might mean this goes down more than 10%. It's a leveraged play on gold. And the other thing that's important here is the beta versus the S&P is it's only 40% as volatile as the S&P. So it's less volatile, which is important. So you're not only getting great rates of return, but you're not having this thing shoot through the moon into the, like GameStop or, AMC, where every time you look at it, it's up 20%, down 20%. It's not going to give you a heart attack, which is nice. So this chart over here is really, really important to see because look at GDX. That's the index for all the gold companies ever, anywhere that are in the GDX. So it's a very broad thing. And you can see gold did really well above the markets here. From 2007 to the high of 2011, gold companies beat the markets. But ever since then, it's kind of not that good. It's kind of come back up lately, but as you know, the stock market, you saw from the last episode, has just been gangbusters growing. So of course, this looks like it's not doing well compared to the regular stock market, and that's the GDX. But look at this gold or bronze colored chart. That's Royal Gold. So while all gold is down here and all the stock markets are here, so the light blue is spot gold. Okay, so that's the gold price, which kind of shows you the gold companies have done worse than the gold price. And I kind of know what that feels like, because some of my gold companies, when gold goes up, they go up, but then when gold just stays flat, they seem to slowly drift down. It's like people lose interest in those stocks, and they aren't growing, or the gold isn't moving up. So I'm getting tired of owning this gold company, so they dump it. Especially when there's a pullback in the market, and they get margin calls. People tend to go, well, what can I get rid of to fulfill this margin call? Oh, that boring gold company I have, I'm going to dump it. But Royal Gold, because of the great dividend growth and all the other things, it doesn't get hurt when the pullbacks happen. So it's outperformed 3.66 times the index. That's amazing, right? So, but you can see it's a little spiky here. So, like I told you, when gold goes down, or something happens, maybe this isn't even when gold goes down. I don't know what that spike down was about. But anyways, over the long run, it does really well. Better than the NASDAQ, better than the S&P. Well, it doesn't say NASDAQ. S&P 500 and the Dow Jones Industrial Average. So better than those two. The NASDAQ is a special case. So gold is uncorrelated and diversified that provides a hedge against systematic risk, currency depreciation, and inflation, which is what we talked about in the last episode, that fear of higher and higher, maybe even hyperinflation is coming, and gold does well in low interest, high inflation environments. So this chart right here is important to see because the value of gold, commodities, and currencies. So this one flat line is gold. So the kind of the denominator of this equation is gold. It stays constantly at 100. Here's what everything else has done, all these currencies compared to gold. So what that's saying is as the currencies lose their purchasing power, that gold doesn't. So the way it's showing it is gold's a straight line across at 100, and all of these currencies, the Australian dollar, Swiss franc, pound, US dollar, euro, yen, Russian ruble, you get the point. Everything goes down over time in comparison to gold. That's what we talked about in the last episode. Gold outperforms fiat currencies over time. The average annual return, gold versus commodities, in a low inflation time, this is gold, this is commodities. In a high inflation time, which is something that might come up in the future, this big, huge return over 15% is gold. Now, of course, commodities, we're talking copper, other things, nickel, whatever, they also go up in a high inflation time. And that's what we're starting to see now. We're starting to see those nickel, those coppers, those other commodities starting to go up. And gold and silver have been pushed down by these big banks have been using the COMEX and the paper price of gold and silver and shorting it, pushing it down. And they can't do it forever because eventually there will be a short squeeze, as that Reddit crowd did. They did a short squeeze on silver and silver companies. And my biggest one on that list there was First Majestic Silver. And that thing took off when that short happened, the short squeeze happened on silver. So there you go. I think they can't hold gold and silver down forever. And at some point it's going to pop and go a lot higher, in my opinion. Okay, over here, gold has performed well in an environment with low rates and increasing money supply. And that's exactly where we are now. As we said in the last episode, the money supply has increased by 40% in the last year. That's a lot. That's crazy. And here's a graph of it. So this is the gold count. Now this isn't Royal Gold. Remember, Royal Gold does better than gold. This is just gold compared to the money supply. So it goes above the money supply, it goes up faster than the money supply, which is good. But then picture Royal Gold does 1.77 times that, so it'll be even better. I'm surprised they didn't actually throw their own graph on here, but it is what it is. Royal Gold. So these are all the key characteristics that Royal Gold has versus ETFs, senior operating companies, junior operating companies. So in other words, they tick all the boxes. They get exposure to gold, they get exploration to the upside, portfolio diversification, sustainable dividends, no direct exposure to operating costs. In other words, they don't actually pay for the fuel in the trucks and all that stuff. They just get the gold that comes out at the end. And no direct exposure to capital costs. Again, they're given the money and say, give us this percentage of your revenue, not your net earnings, but your revenue, or give us this percentage of every ounce of resource you get out of the ground. So it's a win-win for them. They almost guarantee when they give the money, they're going to make money. Case study. So here's a gold mine from Alamus Gold. So it's a gold company who needed money. So Royal Gold acquired a 1.5% net smeltering royalty. So it means they get 1.5% of all the gold or other silver, whatever else comes out. And in 2 million ounce cap was reached in March 2019, but they had a clause that says they get 1.5%, and then after that, they get a lesser percent into perpetuity or whatever. That ended up being a pre-tax return of 36%. And the mine, because of the money that they put into it, actually drilled more, expanded more, and now the mine has a life extension through 2025 when they were only expecting it to go to, I believe, 2019. So there you go. They give the money to the mining company. The mining company gets to use it to explore more, build the mine bigger, and everybody wins. Return drivers, acquisition based on mine feasibility study. So what they do is they always check out the mine feasibility study before they ever put any money into any of these companies. Okay, so here's the enterprise value per employee, and this is why they can be so profitable. The enterprise value per employee compared to all of these well-known companies, some tech companies, Amazon, Alphabet, Facebook, and then gold companies up here, Newmont, Barrick, Glencore, Rio Tinto. So it's like dwarfs all the other people. Royal Gold, 300,800 per employee in revenue, in enterprise value. Total revenue, 17,181 revenue per employee. So there we go, dwarfing everybody else. Here's where it shows how profitable they are. So that 499 million that I said they got in 2020, they got 78% of that is their earnings before interest and taxes. That's a 78% margin. Then of that, the operating cash flow, after they take out whatever things they need to sustain the business, then they still have 68% of the money left. Is that insane? 68% of the money goes right to the bottom line in terms of cash flow. And then they're showing you how that happens is really they only have 4% of their expenses is their general and administrative expenses because they have only 29 employees. So it's a very, very profitable company. Again, just talking about their well-established portfolio and how it's diversified across different countries and jurisdictions. Of course, you got a bunch in Canada. You got these two up here in America, and then a whole whack of them in the gold Nevada area, which is a big mining area in the United States. One in Mexico, one in Central America, and then a few over here in Africa and a few down here in Chile. So they're broadly diversified in a bunch of different countries. This is just showing you where their companies are at. We talked about this already. 41 companies are at the production. This is where all the revenue comes from. But it just goes to show you, this is from the infancy stage. This is a little more mature. This is very mature, and this is producing. So they got 82 at the infancy stage, earliest stage of development, 49 at published resources. So they've done studies and published that they have resources. Reserves means that they've proven that they are economic to mine. Though they found out that it's going to cost us this much to get there, to get this much gold, it's going to be profitable. So when you get to that stage, this is when they're starting to build the actual mine to produce it. And of course, once you get to production, you've got a mine that's actually operating and making money. So there you go. Oh, this is the, what's the word for it? Environmental, social, and governance. So back in 2018, I guess the lower number is the better number. So they've gone from a 51 to a 23 to a 22 to an 18. And they are considered a low risk, polluter. They've done a lot of efforts, as they'll talk about below, and they've gone from a BBB rating in this MSCI, which is also a ESG rating, from a BBB to an A. So they've definitely put, as this page will tell you, a lot of time, effort, and money into being environmental, social, and governance. So environmental, you can see it here, what they're talking about. Social, investing in local clinics for the areas, like in Mexico, South Dakota School of Mines and Technology, 2 days pay for every employee to volunteer in communities. You get the point. So they're showing how they got that A rating, and they're putting a lot of effort in, and that's good. And again, they don't own the mines. So they're going to these places where they don't even know the mine and spending, or they don't own the mine and spending money. All feel good stuff. It doesn't go to the bottom line necessarily, but this is the sort of thing that a lot of investors want to see. So this is their due diligence, meaning how much effort do they put into researching a company before they actually give them all this boku to bucks. So they obviously get to know the management, see if they have a great track record. A lot of these people are known in the industry where they've done another mine before, they were successful, they made it profitable, the mine runs out of gold, and they're starting a new mine. So you have to have that great resume of profitably running a mine in the past before they want to get involved with you. They check, of course, the company's financial credit analysis and any legal. They want to make sure that the title, the permitting, and everything in the laws are being adhered to. They don't want any, unforeseen problems with mine permitting. ESG, as we just talked about, they make sure that the mine is environmental, social, community impact. Technical due diligence, they bring their own geologists on. Metallurgy, operating, they bring in accountants, figure out that their operating and capital costs are in line. Infrastructure, marketing, you get it. They don't just throw. It's not like, think of a bank. If you went to a bank and said, I want $10 million, the bank would go, all right, sign over the lease or sign over the ownership to the land if you don't pay us back, and we'll give you the $10 million. They could care less if you're being good to the environment. They just want to know that there's enough assets on your books that you could cover the bank if you had to close shop. So this company wants a good reputation, and they obviously want to make a profit, but they go the extra mile than a bank would. We anticipate financing acquisitions non-dilutive. So this is what existing shareholders want to know, that Royal Gold isn't going to decide we need to issue a whole bunch of shares because we want to invest in some new mine. They have such great cash flow, they don't need it. So they're going from their existing cash balances, which right now is $382 million. Cash flow from operations, which we know is huge. It goes, 68% of the money that comes in is coming in as profitable cash flow. Debt under revolving credit, again, they have credit available of $1 billion. And then equity only when accretive. In other words, if they can take over a mine where the net assets of the mine are worth way more than what they're being asked to pay, then they may issue shares, but they don't do it very often. It'd have to be a really great opportunity for them to do that. They have a lot of money, so I don't know why they'd ever want to do that. So this is the one key thing, especially if you're a retired person and you want a company that you can actually get a cash flow from every month or at least every quarter. Royal Gold has received dividends regardless of the gold price. So they've never not paid a dividend. And here's their dividends. So this let's go down a bit. There it is. So this is the gold price. This, bronze colored line is the gold price. This is the percentage of their cash flow that they're paying out in dividends. So as you can see, when gold's low, they're paying, 20, 25, 26%. And then as gold went up, they started paying more. These gray lines are how much they paid in dividends. So you see it always goes up, never goes down. But as a percentage of their cash flow, when gold went to the moon here, they actually paid less of their cash flow, which means they have more money to invest in other new ventures, which is good. So you can see that the rate of increase got real steep here because gold went up. But even though they were paying a much bigger dividend every quarter, the percentage of their cash flow wasn't that high. Then, of course, gold comes back down again. Now they've already decided they have to give you a higher dividend because they're trying to stick to that rule, right? They give you a higher dividend, but now it's 36% of their cash flow. And then as things kind of more go up but level out a bit, then they get back to their, probably what they want is to pay out 23, 25, 27%. So they're in here again. So as gold at the end of this chart is going up, you can notice that the percentage that they're paying out is going down. So that's good. So again, lots of cash flow. Okay. There's one more area that I highlighted because it is important. So streaming companies have historically traded at relatively high price to NAV net asset value and price to cash flow. And what they're showing in this grayed area is their competitors. And it says right here at the bottom, they're comparing themselves to other royalty companies, not to other gold companies. So Franco-Nevada, Wheaton Precious Minerals, Osisko Gold Royalties, Sandstorm, these are their peers of royalty companies. So here's something I noticed is that because Royal Gold is so good and so efficient, they tend to be at least mid-range, sometimes at the high end of their price to net asset value, which means their price to the assets they have is on the higher end. Occasionally it's low, but a lot of times it's at least mid-range and sometimes it's at the high end. But their price to cash flow is almost always at the low end. And that's because they have X number of millions of dollars of assets on their books. But cash flow, it means that their assets go right to the bottom line, right to the cash flow. And since they're so efficient at getting everything to go right to the cash flow, their price tends to be at the lower end of their peers, which means this is what you really want. You want your price to cash flow to be under the competitors, which means it's not overvalued compared to the competitors. So that's one area that I thought was important, and the rest is all about their gap and their quarterly thing. So if you go to here, you can see that their numbers have been going up. Now, this is only 1 year over 1 year. This is just a presentation. It's not all of their financials for the last 10 years, which would have been nice, but it's not in here. So there you go. So now we've talked about fundamentally, and I hope you can see why. This is one of those companies that they always make money. They always pay a dividend. So this could never go to zero in my mind. You're never going to lose all your money. Could you buy it when it's not the right time to buy it and a year later it's actually slightly lower? It's hard to imagine because they seem like they're always growing, but it's possible. So that's the next stage where we just want to jump over to the charts and look at the technicals to see if this is a good time or an okay time or a bad time to jump into Royal Gold. Okay, so we've gone over the fundamental analysis of Royal Gold, and as we've kind of proven, it's that steady Eddie that always makes money, it's always paying you a dividend, it's always growing, so that's something like that should make you sleep at night, allow you to sleep at night, not super risky, also not going to make you a billionaire overnight, it's not one of those kind of stocks, but if this is one that I would suggest to somebody who just wants to get into the gold industry, pretty much know that they're going to make money, this is the company for you. So let's go into the next step is technical analysis. Is this a good time to buy it? You've decided you're going to buy this stock. Is now a good time, or is it overpriced, or is it a steal right now? So let's get into the technical analysis. I'll bring up my screen. Here's my interactive broker screen, and you can see I have all the companies I cover or follow right now here. I put up gold as a 15-minute chart, an hourly chart, and a daily chart. So you want to start with gold when you're talking about Royal Gold because Royal Gold's price usually goes as a beta of 1.77, as we learned in the presentation of gold. So if gold's going up, Royal Gold's going to go up, and vice versa. So let's look at gold and just say, where is it? You got to look at it big picture. So let's pull up the daily chart. So here's back to the March pullback, the March stock market drop. Gold itself got hit too, and a lot of people were like, why would gold go down? I thought gold was the flight to safety risk. Well, during a market pullback like this, people get margin called, and any asset they have that they can liquidate to stop those margin calls, they'll do. So gold, of course, gets pulled into that as well. But as soon as the scare was over, gold was off to the races, going from, I guess, around 1450. Wow, didn't realize it got that low. All the way to 2100. Let's get back there. I don't know. Stupid, my mouse moved it. So 2075 maybe. So yeah. Great move for gold. But ever since then, it's just sort of drifted down in a channel. You can almost draw the lines right here. This is a channel. It's drifting down like this, and a parallel channel like this. So you can see that that's going on. But what you can see now is recently it's going to break above this moving average, this quicker moving average. So this is the 50-day. I believe it's going to cross above that hopefully soon. And then the 200s here, if it crosses above that, then you're truly in a bullish market for gold. The resistance in a smaller time frame. So let's go into the hourly chart. Now you can see that momentum is back in gold. And if I zoom out, you can see the channel that I drew in the previous graph. You can see that there was resistance right here, and it's just broken above that. That's the 1750 line. It's just broken above 1750. And so now the next resistance would probably be up here at 1815. So yeah, we've got some room to run, and that's great for Royal Gold. So we'll get out of the gold because we're here to talk about Royal Gold. My charts update with Royal Gold as in a 15-minute, an hourly, and a daily. And the different time frames are important based on how long you plan to keep the stock. If this is a day trade, which I would never suggest, but if it was a day trade, you would look at the 1 minute and the 5-minute charts. If it's a swing trade, you're going to own for a few, a week, 2 weeks, 3 weeks, then you'd go to the hourly and maybe look at a 5-minute for entries and exits, but look for the hourly chart. And if this is a long-term holding, you're going to look at the daily charts and the weekly charts. So let's get into this. Royal Gold for me is a long-term holding. This is one of those steady eddies that you want to own for a long time. So let's look at the daily chart. And as I've drawn on here, you can see that there is a channel, a consolidation channel that's been running sideways since the beginning of the year, since back in December. So yeah, it's waiting to break out of that, and it's almost there now. It's trying to break out above that 112.50. If it does, then it's probably going to run up to about 126, and then above that, the next resistance I got is about 139. So yeah. So with gold being in a more upward momentum drive right now, its MACD is positive. It's hard to see the MACD on the daily, at least, with the Royal Gold, because it's such a steady eddy. It doesn't move that much. So the MACD never really gets super high and low. The only time it did was back in the March meltdown, where it got way oversold, and then up here after it snapped back, when gold snapped back, then it got a little bit on the overbought. But ever since then, it's kind of come back to the mean, where it just goes a little bit above or a little bit below the MACD line. So it is what it is. Slow and steady wins the race a lot of times. So yeah, I think with gold being in an upward trajectory, Royal Gold should be good for a while. So especially if you can get above this, let's say this 113 line, then you've broken resistance and you should be off to the races to about 126. So if you want to do that, if you want to wait for a breakout, do that. If you're just saying, look, I don't have time to stare at this charts day after day to see if this breakout happened, you probably can go ahead and get into it now, knowing that you've got support in the bottom of this channel here at worst case scenario if the market and gold was to roll over. So there you go. So hopefully you found this informative. Just to recap, you want to start off looking fundamentally at a stock that you're thinking of. Learn everything you can. Go onto their website, go to the investor relations area, read their presentations, look at their financials. Once you decide, yeah, that's a company I want to invest in, then the next step is to go to the technicals, which is looking at the charts, looking at resistance, support resistance, seeing if MACD or the RSI is showing that the momentum is in the direction you want it to be. And if everything lines up, then it's a good time to get in, then go for it. Not advocating any sort of day trading, because I think most newer investors just lose money. It's like a roulette table when you're day trading, trying to get in and out within a day, and people just tend to blow their accounts. So don't do that. But long-term trading, you're really just looking for fundamentally strong companies, and I believe Royal Gold is one of those. Steady eddies, always makes money, always pays a dividend, and it has a higher beta than gold. So if you think gold's going up, then Royal Gold will also go up more. So there you go. Hopefully you found that enjoyable or informative. If so, show the channel some love by giving it a thumbs up. Subscribe to the channel so you can get more content like this. Just as a heads up, the next content I plan to do is jumping out of the gold area into the cryptocurrency. So my next episode will be, what is Bitcoin? Explaining what Bitcoin is, how does it work, how do we know how many coins there are out there, what's Ethereum in comparison to Bitcoin, because one's a proof of work type of infrastructure and one's a proof of stake or moving to that. And other proof of stake altcoins that I like are Binance Coin, Polkadot, Cardano. I have VeChain, which is a property tracking chain. So anyways, lots to learn in the cryptocurrency area. So that'll be the next kind of big area on this channel. So if that's something you're looking forward to, again, subscribe and hit that bell notification so that you know the minute a new episode is out. So without any further ado, this is Craig signing off, saying ciao for now.
I love gold. I love gold so much that I even lost my genitalia in an unfortunate smelting accident. Hence the name Gold Member.